You worked 40 years to build your nest egg, but the exact moment you punch the clock for the last time, the IRS flips a switch and starts tracking 5 specific areas of your life that they completely ignored while you were working. If you don't know what these 5 tripwires are, you could lose up to 50% of your retirement income to surprise taxes and hidden penalties. But there is one specific move you can make with your Medicare premiums that changes everything. And I am going to show you exactly how it works. Welcome. I want to talk to you today about something that keeps far too many retirees awake at night. When you transition from earning a paycheck to living off your savings, the rules of the game fundamentally change. The tax code you have been using your entire adult life is suddenly replaced by a completely different rule book. Over the last decade of helping people navigate this exact transition, I have seen good, hardworking people get absolutely blindsided. We're going to walk through the 5 things the IRS starts watching the moment you retire. We will look at how your Social Security can suddenly become taxable, the brutal penalties tied to mandatory withdrawals, the trap of working part-time, the hidden danger of moving your money around, and finally, the most shocking penalty of all, how taking a simple profit on a stock can legally force you to pay double for your health care. Grab a cup of coffee and get comfortable because we are going to dive deep into protecting everything you have built. Let us start with the first thing the IRS begins scrutinizing the moment you retire. And this is arguably one of the most frustrating rules in the entire tax code. For your entire working life, you paid into the Social Security system with after-tax dollars. Every time you looked at your pay stub, you saw the FICA tax draining your hard-earned money. You were told this was a safety net, a guaranteed benefit waiting for you at the finish line. So it comes as a massive shock to most retirees to discover that the IRS is watching exactly how much money you pull from your own savings accounts. Because pulling out too much can instantly make your Social Security benefits taxable. This trap is governed by a deeply flawed calculation known as provisional income. The IRS does not just look at your standard income to decide if your Social Security should be taxed. Instead, they use a shadow formula. They take your adjusted gross income, they add in any non-taxable interest you might have, such as income from municipal bonds, and then they add exactly 50% of your Social Security benefit. If that total number crosses certain thresholds, the IRS steps in and taxes up to 85% of your Social Security checks. Here is where the tension really builds. These thresholds were established back in 1983. At the time, Congress promised that this tax would only ever affect the absolute wealthiest retirees, perhaps 1 in 10 people. To keep that promise, they set the thresholds at $25,000 for a single filer and $32,000 for a married couple. But here is the catch. They deliberately left out an inflation adjustment. They never indexed those numbers to the rising cost of living. Fast forward to today, and those thresholds are exactly the same as they were decades ago. Because of inflation, what was once a tax on the ultra-rich is now a tax on average middle-class retirees. Over half of all retirees are now caught in this trap. Did you know that taking a simple $1,000 withdrawal from your IRA to fix a leaky roof can actually cause $850 of your Social Security to become taxable? It is a cascading effect. You pull money out of your pre-tax accounts to live on, that money raises your provisional income, and that higher provisional income triggers the tax on your Social Security. You end up paying taxes on the IRA withdrawal, and you pay taxes on the Social Security benefits you were counting on. We call this the tax torpedo, and it can push your marginal tax rate far beyond what you ever experienced while you were working full-time. The payoff here is control. You have to realize that the IRS is watching your income stream, so you must carefully sequence how you withdraw your money. If you can pull funds from a Roth IRA or utilize cash from a standard savings account, those distributions do not count towards your provisional income. By balancing your withdrawals between taxable IRAs, tax-free Roth accounts, and taxable brokerage accounts, you can legally suppress your provisional income and keep the IRS's hands off your Social Security checks. You have to stop viewing your retirement accounts as one big pile of money and start viewing them as distinct tools to manipulate your tax bracket. The second area the IRS begins to monitor with ruthless precision is the timeline of your life, specifically regarding required minimum distributions, or RMDs. While you were working in your 30s, 40s, and 50s, the IRS was incredibly patient. They allowed you to put money into your 401k and your traditional IRA on a pre-tax basis. They allowed that money to grow for decades without asking for a single dime in taxes. But the IRS views that arrangement as an unpaid loan. And the moment you hit your early 70s, they come to collect. The government forces you to start taking money out of your pre-tax accounts, whether you need the money to live on or not. They dictate the exact percentage you must withdraw based on your life expectancy, and they watch the calendar with zero forgiveness. If you miss the deadline, or if you calculate the amount incorrectly, the IRS imposes one of the harshest penalties in the entire tax code. Historically, this penalty was a staggering 50% of the amount you were supposed to withdraw but did not. Recent legislation lowered that penalty to 25% and potentially 10% if corrected quickly, but it is still an absolutely brutal punishment for a simple clerical error. The real tension with required minimum distributions lies in a trap called the aggregation rule. Many retirees spend their careers changing jobs and rolling over different 401k plans into various IRAs. By the time they retire, they might have 3 or 4 different traditional IRAs scattered across different financial institutions. When it comes time to take your RMD, the IRS calculates a specific minimum withdrawal amount for every single one of those accounts. You are allowed to total up the required amounts from all your different IRAs and take that total sum from just one of the IRAs. The IRS allows this aggregation for IRAs. But here is the trap that catches thousands of retirees every year. If you also have money left in a 401k or a 403b from a former employer, you cannot aggregate those accounts with your IRAs. A 401k requires its own distinct distribution. If you mistakenly add your 401k RMD to your IRA RMD and pull the whole amount from your IRA, you have technically missed your 401k distribution entirely. The IRS will immediately flag this, and the penalty letters will start arriving in the mail. Furthermore, the IRS is watching to see how you handle your very first RMD. The rules state that you can delay your first ever distribution until April 1st of the year following the year you reach your RMD age. On the surface, this looks like a nice grace period from the IRS. It feels like a favor, but it is a trap. If you choose to delay your first distribution into the following year, you still have to take your second distribution by December 31st of that same year. Have you ever stopped to calculate what happens when you cram 2 massive forced withdrawals into a single 12-month tax window? It artificially inflates your income to levels you may never have seen before. It pushes you into a significantly higher tax bracket. It triggers the Social Security Tax Torpedo we just discussed, and it exposes you to Medicare surcharges. The IRS is hoping you take the bait on that delay. The protective move is to almost always take your first distribution in your actual birth year, smoothing out your tax liability and keeping your income profile as flat as possible. The third thing the IRS begins watching closely is your desire to stay busy. Retirement is a massive psychological shift. Many people spend a year playing golf, traveling, and sleeping in, only to find themselves profoundly bored. They miss the intellectual stimulation, the social interaction, and the sense of purpose that comes from working. So they decide to take on a part-time job, or they agree to do some consulting work for their old firm. The moment you start generating earned income again, the IRS and the Social Security Administration open up a whole new file on you. If you decided to claim your Social Security benefits before reaching your full retirement age, you are subject to the earnings test. The government essentially says that if you are still capable of working and earning a meaningful income, you must not actually be retired, and therefore you do not need your full Social Security check. They set a strict limit on how much you can earn from a job. If you earn even $1 over that limit, they begin withholding your Social Security benefits. They withhold $1 in benefits for every $2 you earn above the threshold. This creates an intense cash flow crisis for retirees who are not expecting it. Imagine taking a part-time consulting gig because you wanted a little extra spending money for a family vacation. You earn $30,000 from the gig, which pushes you well over the earnings limit. Suddenly, your Social Security checks completely stop arriving in your bank account. You call the administration in a panic, and they coldly inform you that your checks will be withheld for the next several months to offset the penalty. The vacation is canceled, and you are left scrambling to pull money from your savings just to pay your baseline utility bills. Now, it is true that the money withheld is not permanently confiscated. When you finally reach your full retirement age, the Social Security Administration recalculates your benefit upward to account for the months you did not receive a check. But that is a hollow victory when you are facing a severe liquidity crunch today. Furthermore, the IRS is watching exactly how you earn that part-time money. If you take a job as a standard W-2 employee, you will pay standard payroll taxes. But if you are acting as an independent consultant, which is what most retired professionals do, you are stepping into the trap of self-employment taxes. When you are self-employed, you do not just pay income tax on what you earn. You also have to pay both the employee and the employer portions of Social Security and Medicare taxes. This is known as the SECA tax, and it eats up an immediate 15.3% of your net earnings before you even begin to calculate your federal or state income taxes. A retiree who takes a consulting gig thinking they are getting ahead can easily find themselves losing 40 to 50% of that new income to a combination of self-employment taxes, standard income taxes, and the temporary loss of their Social Security benefits. The IRS watches your part-time hustle very closely, and if you do not plan for the tax implications, your attempt to stay busy will end up feeling like volunteer work for the federal government. We still have two massive areas to cover, and while the part-time work trap is incredibly frustrating, it pales in comparison to what we are going to talk about in our final point. If you have any money at all in a regular brokerage account, or if you plan on selling a piece of real estate, you absolutely cannot afford to miss how the IRS communicates with Medicare. It is the single biggest stealth tax in retirement, and it catches almost everyone off guard. But before we get to that ultimate trap, we need to talk about the trap door hidden inside the strategy everyone tells you to use: Roth conversions. The fourth thing the IRS watches with a magnifying glass is how you attempt to move your money from taxable accounts into tax-free accounts. Everywhere you look, financial commentators are screaming about the benefits of Roth IRAs. The pitch is incredibly compelling. Pay the tax now, get the money into a Roth, and you will never pay taxes on that money or its growth ever again. It sounds like the perfect defense against rising tax rates. But the IRS knows you are trying to escape their future grasp. So they instituted a devastating roadblock called the pro rata rule. Let me explain the tension here, because this ruins the financial plans of thousands of retirees every single year. Let us say you earn too much money to contribute directly to a Roth IRA. Or you just want to strategically convert some after-tax money you have sitting around. You make a non-deductible contribution to a traditional IRA. This money has already been taxed. Your plan is to immediately convert that specific chunk of after-tax money into a Roth IRA. In your mind, because the money was already taxed, the conversion should be completely tax-free. You execute the transfer, you feel incredibly smart, and you go on with your life. But the IRS does not view your accounts the way you do. You look at your traditional IRAs as separate buckets. You think you can point to one specific bucket of after-tax money and move it. The IRS, however, views every single traditional IRA, SEP IRA, and simple IRA in your name as one giant blended blender of money. To the IRS, you cannot separate the pre-tax money from the after-tax money. Think of it like pouring milk into a cup of dark coffee. Once you stir it together, you can no longer take a sip of just the milk. Every sip you take will be a proportionate blend of coffee and milk. This is exactly how the pro rata rule works. If 90% of all your IRA money is pre-tax and 10% is after-tax, then any conversion you do will be considered 90% taxable, regardless of which specific account you actually pulled the money from. People fall into this trap all the time. They execute what they think is a tax-free backdoor Roth conversion in February. Then, later in the year, they retire and roll their massive pre-tax 401k into a traditional IRA to get better investment options. The IRS calculates the pro rata rule based on your total account balances on December 31st of the year you do the conversion. Because that massive 401k rollover flooded their IRA ecosystem with pre-tax money right before the end of the year, their supposedly tax-free conversion done 10 months earlier is suddenly 99% taxable. The payoff here is meticulous tracking and isolation. The IRS watches Form 8606, which is where you report these non-deductible contributions and conversions. If you want to move after-tax money into a Roth without getting crushed by the pro rata rule, you have to legally hide your pre-tax money from the IRS's December 31st snapshot. The only way to do this is to roll all of your pre-tax IRA money into a current employer's 401k plan, because 401ks are completely exempt from the pro rata calculation. You have to empty the coffee cup completely before you pour the milk in. If you do not understand how aggressively the IRS watches the blending of these funds, your attempt to build tax-free wealth will result in a massive unexpected tax bill in April. This brings us to the fifth and absolute most critical thing the IRS starts watching the moment you retire. If you forget everything else we have discussed today, remember this point because it is the most expensive mistake a retiree can make. While you were working, you probably viewed your health insurance and your tax returns as two completely unrelated things. Your employer handled your health insurance and your accountant handled your taxes. But in retirement, those two worlds collide in a spectacular and devastating way. The IRS actively communicates your exact tax data to the Social Security Administration to determine how much you will pay for Medicare. This is the trap of capital gains and the Medicare IRMAA surcharge. IRMAA stands for Income-Related Monthly Adjustment Amount. When you go on Medicare, you pay a baseline premium for Part B, which covers your doctor visits, and Part D, which covers your prescription drugs. For most people, this baseline premium is manageable, but Medicare is means tested. If your income goes above certain strict thresholds, the government decides that you are wealthy enough to pay more for your own health care. They apply a surcharge that can literally double or triple your monthly premiums. Here is the setup for the disaster. You have been retired for a few years, you are living comfortably on your fixed income, you decide you want to buy an RV to travel the country, or maybe you want to help your grandchild pay for a wedding. To fund this, you sell a piece of land you have owned for 20 years, or you finally liquidate a large position in a stock that has grown significantly. You expect to pay the capital gains tax on the profit. You sit down with your accountant, you pay the 15% capital gains tax, and you think the transaction is completely closed. But the IRS is watching that capital gain, and they send that data directly to Medicare. However, they do not do it immediately. They operate on a 2-year look-back period. The income you generate in 2024 determines your Medicare premiums in 2026. 2 full years after you sold that stock or that piece of real estate, you receive a highly official letter from the government stating that because your income was so high 2 years ago, your Medicare premiums are being drastically increased for the upcoming year. Why is this so insidious? Because IRMAA is not a gradual tax. It does not ease you into the higher premiums. It operates on a brutal cliff system. Let us imagine the threshold for the first surcharge is $206,000 for a married couple. If your modified adjusted gross income for the year comes in at $206,000 exactly, you pay the standard baseline premium. But if your income comes in at $206,001, you fall completely off the cliff. That single extra dollar of income does not just cost you a few pennies in tax, it triggers the surcharge for the entire year, forcing you to pay thousands of dollars more in Medicare premiums over the next 12 months. Did you know that the IRS includes completely tax-exempt municipal bond interest in this calculation? You could be sitting on bonds that you specifically bought because a broker told you they were completely tax-free. They do not increase your federal income tax, but the IRS adds that interest right back into your modified adjusted gross income for the IRMAA calculation. You could be pushed off the Medicare cliff by income that isn't even taxable. This stealth tax destroys the budgets of middle-class retirees who experience a one-time liquidity event. A Roth conversion, a large withdrawal to pay off a mortgage, or a simple capital gain can haunt you for years. The protective payoff here requires absolute vigilance over your modified adjusted gross income. You must calculate exactly where you stand relative to the IRMAA brackets before you sell an asset or execute a conversion. If you are close to the edge of a cliff, you must stop. Delay the sale until January 1st of the next year, spreading the income over 2 tax years to stay under the limit. Furthermore, you must know that you have the right to fight back. If your income spiked because of a specific life-changing event, such as a formal work stoppage, the death of a spouse, or a divorce, you do not have to accept the 2-year look-back penalty. You can file Form SSA 44 with the Social Security Administration, proving that your income has permanently dropped, and legally demand that they base your Medicare premiums on your current reality, not the ghost of your past tax returns. But the government will not offer you this form. You have to know it exists, and you have to have the courage to file it. We have covered immense ground today. The transition into retirement requires you to become fiercely protective of your wealth. We explored how provisional income thresholds, frozen in time since the 1980s, can suddenly make your Social Security benefits taxable. We discussed the unforgiving deadlines and aggregation traps of required minimum distributions. We uncovered the severe cash flow penalties and self-employment taxes waiting for those who try to work part-time. We exposed how the pro rata rule views your traditional IRAs as a blended cup of coffee, ready to ruin your tax-free Roth conversions. And finally, we revealed the ultimate stealth tax, how a simple capital gain today can force you off the IRMAA cliff, doubling your Medicare premiums 2 years from now. You have worked entirely too hard for far too many years to let the IRS siphon away your financial security just because the rules of the game suddenly changed. Knowledge is your only defense. I want to hear from you. Have you or someone you know ever been blindsided by the tax torpedo on your Social Security, or received that terrifying IRMAA letter in the mail from Medicare? Drop your experience in the comments below. Sharing your story might just be the exact warning someone else needs to hear to protect their own life savings. Thank you for spending your time with me today, and I will see you in the next one.